Hello, everybody. Good evening, good morning, wherever you are, good afternoon. Uh, Thank you for giving me your time and attention tonight. I certainly appreciate that. And this is, I've just been thinking as I've been preparing for these sessions, how much I enjoy thinking about this stuff and talking about this stuff and sharing these ideas with people who are interested and passionate and at various stages of figuring this out for yourself. So it's really an honor to be able to spend some time with you here and think about chapter 2 of the book. So a thought about the kind of the structure of the book was one of the things that I wanted to be very careful about was not to have too much repetition. And it was very easy because obviously there's some important topics that come back time after time after time. So even in the initial planning stages, I found myself wanting to repeat some things over and over. And that was something that we really consciously massaged and worked on all through the structure of the book. And I tell you that because I can tell you that the repetition that is there is deliberate. But as we think here tonight about the Wyckoff Cycle. And this is the quote that, which I'm sure everybody here has heard from one source or another, whether pop music or scripture. This quote, "To everything there's a season, a time to every purpose." This brings into our awareness and our experience a reminder that so many things are cyclical. If you think about market cycles, so what does that mean? It means different things to different people. But on one hand, you have people doing a lot of digital signal processing, and there are tools. And by the way, some casual chart analysis. Sometimes you can pick out some recurring cycles, and there are reasons for some of those things on a daily chart or even an intraday chart. If you think a little bit bigger, you think about particularly commodities have a cycle, a production cycle. So there's a time when they're growing, a time when they come out of the ground, a time when they're stored. Energy is a little bit different, but there's still, there are all of these different cyclical demands and stresses on markets. And one of the things that really fascinates me is thinking about how markets are in so many ways a reflection of the human experience. Now, is this necessarily something, what I'm gonna point out here, is this something that you're gonna sit down in front of your screen tomorrow and say, oh, I know how to execute a trade? This is not necessarily tradable. But I think this idea, if you think a little bit more about how your experience is completely, what's the word, intertwined with cycles, everything from your heart beating several times a minute to your breathing to the long-term cycles of your life. I think that as much as we're wired to find patterns, and we're going to talk about this quite a bit tonight, we're also wired to think in terms of cycles and in terms of seasons. Well, we see that all the time, depending where we are in the world. So what we're going to cover tonight, first of all, is the Wyckoff Cycle. We're going to look at how that expresses itself in the market. I know everybody here has read the book. I'm not going to read the book to you again. I'm not going to talk too much about the material that's already in the book. We're going to talk about practical application of this, and frankly, issues of practical application. We're going to talk a lot tonight about support and resistance. I'm going to share some things that I don't think I have ever shared publicly. And then we're going to talk about this 4-trade structure and kind of set a framework here for the next few sessions where we're going to talk about trend and trading range and how those fit together, how those interface is the word that I use. And so that's the plan for tonight. If you have questions, go ahead and type them in the chat box. If you already sent us questions, I have them over here on this monitor, and I'll get to most of those at some point tonight. Can't promise we'll get to every question, but just go ahead and, if something pops up. And I do also want to say that I have Betsy and Tom both here with me tonight, so I appreciate the support. They're also going to be monitoring chat, and they can answer some of your questions there, and they'll make sure that I see the questions, most important questions. So let's get started. I also want to respond before we jump into the Wyckoff cycle. Wyckoff was a discretionary trader. And there were a couple of interesting pieces of feedback that were floating around after last week's session. And one of the kind of perennial things that pops up out there is particularly in the internet. Well, one of the things you need to realize about forums on the internet, and I'm sure most of you know this, but for you newer traders, you're going to find a vast difference in quality of participants. And there are many, many forums because trading's very difficult, newsflash, right? And I think the stats that 95% of people who try to trade fail, I think that's probably optimistic on the success side. I think it's probably fewer than 5% succeed in any meaningful way. So this means there's a lot of failed traders, and those people are angry, and they get angry in internet forums. And one of the things they get angry at a lot is discretionary trading. There is this idea that if you can't quantify it, if you can't code it, then it's worthless. And I think we need to be careful because most criticism does, even if it's wrong, even if it's off base, does hold a seed of truth. And I think that the seed of truth is, and this is something you need to be careful about, it's very easy to say I'm a discretionary trader and to let that hide a lack of work. Or if you say I'm a discretionary trader, many times that means that we don't have a rigorous process for evaluating market ideas until we start trading. And then the process of trading is a rigorous process, and it will evaluate your trading ideas. This is one reason why traders fail. So when we say discretionary trading, we need to be sure that I'm very careful that it's not an excuse for imprecision. It's not an excuse for being lazy. On the other hand, why don't we just quantify everything? Why might we prefer to be a discretionary trader? I think the reason is, and the reason this is how I have chosen to craft a good portion of my trading career. And yes, every now and then I make noises, and I even do quite a bit of work about wanting some more systematic strategies running. And I think, frankly, as I get a little bit older, I'll probably do more in that direction. But I come back time and time again to the advantages of discretionary trading. And one of those is kind of automatic. One of those advantages is kind of automatic built-in adaptability. For instance, if I were not careful about how I think about things, I would tell you that I trade exactly the same way today that I did 5 years ago, that I did when I wrote the book, and that I did 10 years before that. I do trade in essentially the same way. But what has happened is over time, I've made a lot of small adaptations. And these adaptations have sometimes been in response to, actually, maybe this is an interesting idea, interesting thing to think about. I didn't really think about this, about making this formal in the presentation. But why adapt? Sometimes it's outside nudges. And we talked last week, I think we'll talk a little bit more about the move to more fixed targets. That was a constructive nudge that I got from Tom. And somebody else looked at the results, looked at the data, and said, here's something I think you're probably missing. One of the other ways that my trading has evolved is by me putting myself in new situations, trading new products, new time frames. And so, I've talked about this day trading venture, and this is a case, this is not a market that is new to me. You go back 20 years and I was, by pretty much any measure, a pretty expert intraday trader, but you don't do it for long enough and the market changes a little bit and then it is new. But by putting myself in the situation where I'm forced to deal with time frames with, another example, a lot of currency traders trade 4-hour charts, and I had never really done that much trading on 4-hour charts. My trading was in shorter time frames or on daily time frame. And if you go to 4-hour charts, there's some adaptations you have to make to patterns. And doing that in that isolated time frame also kind of bubbles out into, it changes the way you see everything. So the other piece of this that is happening is the market is also evolving and changing over time, whether you know it or not. Andrew Lo, L-O, it's a name you probably should know if you're interested in thinking, it did not mean to rhyme, if you're interested in thinking deeply enough about trading problems. Andrew is an academic who also has a lot of very practical experience, and he does research, he does rigorous research, and it comes up with ideas that really do go much further than the traditional efficient market hypothesis that says nobody can make money trading, so why even bother? One of Andrew Lowe's ideas is this idea that the market is an ecosystem. I think he calls it the adaptive markets hypothesis. And you have groups of traders who essentially function as prey, predators, and there's this, in an ecosystem, there's an adaptation, right? The prey animals evolve camouflage and mimicry and deception, and the predators become faster and find ways to see through that. So you kind of have this ongoing arms race in a stable ecosystem, and over a large period of time, a stable ecosystem is not unchanging. And this goes back to the idea of cycles. It's not that we get in a thing where there's just like these two quantities that are sitting here. It's constantly evolving and it's stable within that change. And this is something that I think very much happens in markets. If you're a systematic trader, you really have to adapt very precisely to these things. Your system will stop working and you'll see you need to massage some parameters, maybe do some things completely differently. I think one of the things that has happened, people are still marketing, at least. I don't think many people are trading so much a pure, what we call like a trend following approach that the turtles traded, because the markets changed in ways that made those not as useful today as they were in the late 80s and the early 90s. So the market does change. If you are a discretionary trader, you are very likely to evolve and change along with the market, and you might not even know it unless you are thinking very deeply and focusing very deeply on what's happening in your trading process. There's also, humans are really bad at a lot of things. We make a lot of mistakes. We're vulnerable in so many ways, but we are very, very good at pattern recognition. We'll talk about how that misfires here in a moment too. But your big wet brain is, at least today, capable of doing pattern recognition in a way that computers are not. And there's definitely something to be said for that. This is kind of a cool quote here, which I'll read. The left brain analytic system on Wall Street has become overdeveloped. This was written in 1984, so could have been written yesterday. When I found the quote, I assumed it was written last year, but no, 1984. Like a tree that has grown too large for its place in the forest, it has crowded out intuition, vision, and creativity, and Gestalt sensing, which are the properties of the right hemisphere. As professionals of the street continue to try to overpower darkness, opportunities will exist for those who can sense new directions. And I think why am I spending so much time on this? Because I know there are a lot of people at different stages of their trading career who might look askance at discretionary trading. You might think it's not as serious, it's not as scientific, it's not as rigorous. The only way that I can be successful is as a systematic trader. And I've fallen into that pit even as a discretionary trader. This is one of the things that has motivated the heavy duty quant work that I've done. So at the end of the day, it's probably a good thing, but I just do want to point out, and this quote should give you something to think about. I would also point out, we'll talk when we talk about psychology a little bit more, I don't think overpowering darkness is really the way we deal with darkness, but let's also think a little bit about weakness, the weaknesses of discretionary trading. As I said, it can hide laziness. It can also mean leaning too much on your intuition. And the problem with this, in fact, I would say maybe the core problem for discretionary traders is that your entire being, mental, physical, financial, emotional, is a part of your trading success. It's a part of your process. So this is why, famously, to some extent, this applies to even more systematic traders. But a discretionary trader, if you have any stress in your life, um, typical stress would be like a tax issue. So you get audited, or you have a real estate problem, a death in the family, a divorce, something like that, or a lawsuit, something that stresses you in a way that's a little bit difficult to wrap your head around. I can guarantee you will lose money trading. And I've seen many self-aware, experienced, controlled traders, I've done this myself, ignore that and say, okay, well, I think I can trade through this. And if you do want to ignore it, please at least have the sense to scale your size down, because I would absolutely want to be short your trading. It's kind of a nasty way to say it, right? When you're in a period of stress, because your chance of success is very, very close to zero. So you want to be aware, if you're a discretionary trader, that you are such an integral part of the decision-making process that this is a vulnerability. You can see the same data, the exact same conditions in the market, whether it's patterns or however you make your decisions, and you might make radically different decisions on a different day. Another way to think about the same thing: what if you have a pattern that you read in the market? Might you make a different decision if you were looking at that as an entry, or if you were in a trade that was very profitable, or if you were in a trade that was at a loss? Might you make a different decision if you saw that entry pattern and you're coming off of a run of wins or a run of run of losses? So you just need to be aware that your decision making responds to emotional inputs as much as it does to reason. I would also point out that the market is a wicked learning environment. You see that phrase down there, and that's not a moral assessment. It's not. It's actually a technical term from the learning and skill development literature. And we'll talk more about this later, but it refers to an environment where outcomes are not very tightly tied to your actions. So what this means is, if you hit a tennis ball 100 times, and if you do exactly the same thing, of course you can't, but if you do exactly the same thing with your swing, the ball's going to go in the same direction, barring wind, right, or a bug on the ball or something like that. But in the market, you can do exactly the same thing and have this giant spread of outcomes, just because there's so much noise in the market. So this makes, while I do think one of the benefits of discretionary trading is being able to cue into this level of implicit learning, it's also a weakness because it's quite difficult to do that. And it's very, very important, if you do that, that you structure your experience in the market in the right way. Let's take a moment here to talk, and this is not really in this chapter of the book, but it's worth thinking about, to talk about theory of mind. This is a very interesting topic that does not mean what you might think from the name. So what this refers to is the ability to look at how people act and to gain some, you come up with basically a theory of what they're thinking. And this appears to be a fundamental aspect of human cognition, that we can look at other people and we can think what that person might be thinking. It's interesting, by the way, that you want to be careful, because it's tempting to say that this is a fundamental aspect of consciousness, but animals seem to be able to do this to us. Animals seem to be able to, particularly prey assessing human hunters, seem to have a pretty good idea. They seem to have some theory of mind functioning for themselves. The very interesting thing here, and there's a lot of research on this, I'm not going to quote a ton of research, I'm going to give you links on research. It's out there, you can find it if you want. I'm much more interested that, rather than building an academic structure here, I'm interested in the meaning of these things. But there are several research projects that took people and in some cases completely inexperienced traders, and put them in front of screens with fluctuating prices. And the screens had, in some cases, the price changes were random. In some cases, they were people trading, and in some cases, there was a market participant in there trying to manipulate prices. And even these extremely inexperienced traders very quickly developed theory of mind about the market. Now, this can go wrong. It can go wrong in a lot of different ways, but I want to encourage you to, because if you trade, you've had this experience and you very likely have made a mistake on one of two sides. Either you have gone all in with absolute certainty that you know what the market is thinking, that you know what that guy is doing in the market. That's what, that's what short-term traders will say a lot when they see things happening in the order book. And the other, that's a mistake because you don't know fully. The other side is to completely dismiss that as some kind of like ESP level woo-woo that's going on in your brain that of course is nonsense and you can't pay any attention to. The right answer is somewhere in the middle. It's closer to knowing than not knowing, but this is part of your intuition. This is part of developing your ability to read and understand market action, and it's important, it's absolutely valid, and it's something that college students who have never seen a price chart can figure out how to do in the course of a 2-hour research project. So if you're experiencing it, I hope you are, embrace it and realize that that's going to give you insight into what's happening in the market. Which brings us, that relates here to Richard Wyckoff. Now, a lot has been written about Wyckoff. A lot has been made of his methods. They've been spun out because they are so foundational. There are two broad schools of technical analysis. One is the Wyckoff school, and this is in one of my free trading courses. I have a whole unit that really digs into this. The other was Richard, right? I think Schabacher, who there's a tie-in into what is now called the Bible of Technical Analysis, where Edwards and McGee, where you're looking at specific kinds of patterns. You're looking at, for instance, a head and shoulders or a pennant or a triangle. Wyckoff's approach was quite different. Rather than looking at specific patterns, he wanted to understand what was going on behind the market. And he, in the early 20th century, spent a lot of time talking to and interviewing big traders, people who had accumulated wealth in the market, and he became convinced that the core aspect of market action was manipulation, that you had these syndicates, these groups of people, or in some cases, maybe one big trader who was able to push the market around. And he was quite successful in his trading. This is one of the questions we have with some of the quote forefathers of technical analysis, is that their actual trading results were, we just don't know. Gann in particular, I think his grandson has been very vocal that he didn't make a penny trading. There is evidence that suggests that's not true. I'd say we don't know, but we do know with Wyckoff that he made an absolute boatload of money trading. And after he had done that, and I say trading, not investing, because he was an active trader. He was even a day trader. He was one of the people who, you've heard of tape reading. It's a word that's thrown around on the internet today. Well, what it referred to originally was taking that ticker tape and looking at every trade that happened. So, in the entire market, you could do that when the market was a lot less active, but he understood how to read supply and demand and manipulation even intraday on the tape. And after he had achieved considerable success, he created a course that was a correspondence course. It's kind of what you did back then, and that has become famous. It's public domain. It's out there. Is it worth reading? That's one of the questions here. I saw somebody ask. It's probably worth reading. I think you would find that in some ways and this is a good thing, right? Because some of the things that Wyckoff struggled to teach and struggled to communicate, he did not have the tools to visualize that we have now so readily available with charts. So a lot of what was revolutionary in his work is honestly now available in any semi-scam market app on your phone. It's the charts give us a representation of things that he was kind of struggling to communicate. You also will find that a lot of these ideas, if you listen to serious people talking about the market, a lot of these ideas you have heard because they have become a part of the a part of the world mind at this point, and we anchor on a lot of these ideas. So do you need to go back and read the original material? It's also honestly not very well written. I've read it several times in considerable detail. It's not an easy read. Frankly, I would say for most people, it's probably not worth your time because you're going to extract. I think I'm going to extract the important points for you tonight. But if you're interested, it's public domain. You can Google it and find it right now. His key ideas were about really finding the right places to trade, the right spots where there was some imbalance in the market or where bigger forces were acting on prices and price had not yet moved. This should sound familiar from what we were discussing in our last session. He also was a huge believer in using stops to get out if you're wrong. So while he might not have talked as explicitly about probability and odds as I tend to, he absolutely understood that even with the best analysis and the best work, a trade is still a play on the odds. So maybe you've put the odds in your favor, but you still certainly could be wrong. And the only way to protect yourself from that is to have a stop to get you out if you're wrong. He was also a very big believer in matching techniques to the market environment, to where you are in the market cycle, and this idea of understanding what the composite man is doing. Now, he used that phrase. It's kind of an awkward phrase, but this is a really, really useful concept that you're going to be tempted, I think, when you hear people talk like this, to dismiss it as sloppy thinking. But this is a heuristic that is very useful, and not only useful for objectively understanding what's happening in the market, but useful subjectively to calibrate your emotional responses to price moves. So talk about the composite man, and this was he thought like you had all of these groups and you could just think of them as an operator, as a buy. And today we might talk about the buyers or the sellers. It's kind of the same thing. And if you are not currently thinking like this, don't be afraid to. Don't be afraid to look in an area of price and say, what are buyers trying to accomplish? Now, in the last presentation, I was a little bit critical because if it's anything, it's easy to go too far. You can definitely fall in the trap of thinking everybody is trading exactly like you're trading. So everybody's using a 5-minute chart, they're using my indicator and my moving average, and because everybody sees this little dip in my indicator, that is what made price move. I think that line of thinking is almost certainly wrong, and you want to be careful that you don't fall into that. But the idea of understanding what's going on here in the market, what emotional reactions is it producing in market participants? Is there some smart person in there who is trying to force price to do something else? Can I see those actions on the chart? That's a very, very useful construct to think about markets. Now, in reality, is there somebody doing that? Is that true? I'll tell you, in some cases, it's true, because in some cases, I've been that guy. In some cases, I've been a substantial portion of the volume in some things for a period of time, and I have been conducting operations that would be this classic accumulation that we're going to talk about. So it does happen sometimes. Does it happen at every moment? I don't know. And because I don't know, I would say it's probably safer to assume it's probably not true, but it doesn't really matter because every moment of every market is always manipulated. I kind of laugh when I see somebody bemoaning market manipulation. Oh, they screwed me here, or this was marked up, or this was marked down, or I got a bad fill on this option spread, or whatever. I just everybody listening to this, look, just frame this that you going into the market, every moment you interact with the market is always manipulated, always and in every moment. Just assume that. And sometimes maybe you can untangle that, and sometimes maybe you won't even be able to figure it out. But if you know that that's the market context, it's not a fair game, don't assume it's going to be a fair game. If you feel that you got manipulated against, you have no right to be upset about that. Why? Because you knew the market was manipulated going into it. I think that's the right way to think about this. And what Wyckoff has given us in thinking about the composite operator and thinking about buyers and sellers as groups is a useful trick that can help us understand what's trying to shape prices. And like I say here at the bottom of the slide, I'll say buyers and sellers, but if you do happen to read Wyckoff and he talks about the composite man or the composite operator, it's the same thing when I say buyers and sellers. So what is this composite operator trying to do? Basically, he or they, let's say he, is trying to be positioned correctly before the public knows what's going on. And this is kind of the classic diagram that you see everywhere. This is the 4-stage Wyckoff cycle. So it begins with accumulation, and in accumulation, the market, this composite operator is trying to buy, but he doesn't want you to know he's buying, because if you knew, well, what would you do? You would buy too, right? If you knew that somebody who had tremendous foreknowledge and power to buy the market, so they both desire to and they are able to move the market. If you knew that person was buying, why in the world would you not buy alongside that person? Of course you would. So if that person wants to be successful and buy somewhere down here and not up in the stratosphere, the only way that can be accomplished is if that person can do it without you knowing what's going on. And this means that the ways in which he can buy in this area are limited to buying pretty passively, to doing things like letting the market fall naturally and then stepping in to buy. And above all, this takes time. Now, it's relative, because some people will see this cycle on an intraday chart. And I'll tell you straight up that I don't think this cycle has a lot of immediate practical application. The concept does, the cycle does not, and I think I'm about to prove it to you in the next 3 slides. And at some point, the cat's out of the bag, so to speak, and the market goes into what's called the markup phase, which we recognize as an uptrend. And here, if you think about the psychology, most of you also have seen and Tom or Betsy, maybe you can find this chart that's out there that shows, like, supposed to show the different emotional reactions at different, it's not in my presentation, but the different emotional reactions at different stages in the trend. So, the idea here is that when it starts, nobody notices. And then there's disbelief, right? And then people say, oh, like the fundamentals don't justify this, it's temporary. And then people are fully on board, people believe it, people think it's going to the moon, and then you get in a taxi and the taxi driver asks you about it, and that's where it's over. So it goes from this stage of nobody knows, first of all, disbelief, everybody fighting the trend because that's what amateurs do, generally speaking, and then once everybody thinks that it's real, that's where it's usually over. And at this point, what this composite operator has been doing in this area is probably selling to the public, at least slowly and gently. And then we enter a distribution phase. And here, the operator unloads everything. So it's a very simple plan of buying low, selling high, buying lower, selling higher. But again, the distribution has to be done in a way that the public doesn't see it happening. Maybe the composite operator even goes short, and then what happens? Price breaks down. You have a lot of, through all of this area, you have a lot of hopeful public who thinks it's going higher. Is anybody familiar with Bitcoin? So, we do see this that plays out at least conceptually, but does this, so here's the question. This is the root of a lot of technical analysis. This is a very valid and useful way to think about prices. Does it work in terms of price movement? So let's find out. This is the Dow Jones Industrial Average. And I believe these charts are log scaled. The later one certainly is. I thought we'd just look at a little market history here. These are weekly charts, and I have drawn on them a tool that we use called Algo Swings. And there's a lot of different versions of this. All this tool does is looks for the market to be going up and says we are in an upswing, and then we're watching for a signal to signal a switch to a downswing. So thanks, Betsy or Tom, could you drop that and take a look at that link and drop that in chat, because that's probably what I was looking for. You're looking for a switch to a downswing, and it's done through a combination of pivot points like we talked about in the first session, and also some volatility measures. There are a lot of different ways to do this. You can even do it by hand. I did validate this particular structure with about 100 traders looking at different versions of it back in the day. And so, it's a structure that I like a lot, but it's not the only way to do it. Look here, this looks like kind of classic Wyckoff accumulation in 1934, and then we rocket up out of this. This looks like distribution, right? And then here's the markdown. And then what happens, we go into maybe a more protracted period of accumulation, and then we begin another markup phase. So far, so good, right? Through 1934, through the Second War, through the end of the war, this works pretty well. Here's a big markup into the 1946 area, and then the markdown doesn't really go anywhere, and then it short circuits. I'm not going to go through the entire chart like this, but what I want you to see, here's the next segment of market action. This overlaps a little bit. I try to do that on these charts. So that spot roughly there, 1950, is the beginning of this. I think if you were trading through the 1950s, looking for Wyckoff style accumulation, markup, distribution, markdown, you don't really see it that much. Maybe you have this here, but surely if you were focusing on shorting through here, you easily found yourself on the wrong side of the market. And same thing here, maybe this is a little bit of a markdown stage, but it's also very interesting if you're into history to think about the history that created these movements. And then we get into a really problematic area of market action. Here's the mid 60s through the early 80s. Now, reality check here, okay? So think about what we have just experienced in the stock market. If you go back to 2009, we've had some distortions, right? 2015 was a little rough. 2019, 2020 was fucking scary, right? But we have, if you step back at a certain level, we've been pretty much straight up from 2009. We've been in a multi-decade bull market. And there are other technical analysts who, well, when I say that, they're going to hit themselves in the head and they're going to say, no, there are bear markets in there. And, but I think a common sense application is that we're relatively in a clean bull market since 2009. There is a tendency for humans to extrapolate moves to the moon. And this means there's a tendency for everybody to look back to 2009 and to look ahead the next 10 years and to assume that the stock market is going to quadruple in the next 10 years. It might. I am not a doom and gloom person. Particularly in the market, I will tell you the single most ignorant group of people in the market, and I don't say that lightly. Tom just probably took a big breath. I could imagine what happened. But you're gonna be okay. You're gonna be okay because you'll agree. It's the perma bears. Stock markets over any period of time appreciate, and the people who are constantly calling for a crash, it's probably the stupidest thing that you can do because it is just not borne out by reality. However, what we do need to remember is, and this is my reality check to everybody listening here, we could very well be locked in a shitty, choppy, sideways range for 20 years. It's a possibility. I like to say to our market life people that failure is always an option, right? You assume when you look at a chart pattern, I don't have current charts up today, but the stock indexes are very, very compressed. We have all kinds of conditions that show that volatility is compressed, and everybody's expecting a big move, which we might get, but it's not certain. Excuse me. It's entirely possible that we, rather than have a big move up or a big move down, we just have this sideways failure dribble that could last for weeks or months. You always have to be mindful of that possibility. Traditional technical analysis books don't teach that. They teach you that these are patterns setting up breakouts. They don't teach you that this kind of outcome is here. There's a possibility. Could you have traded the Wyckoff markup markdown thing? You will have these slides. You can pause and look here and consider. I would suggest you probably could not. And here is 79 through the mid 90s. Same thing here. I think if you were if you're looking for any significant distribution, it wasn't really there. So maybe we're not looking big picture enough. Here, if we step back, this is now a very long-term view, log scale of the Dow from the 20s to probably, I don't know what, 2000. And same thing here. I just don't think the structure is borne out by reality in any kind of tradable way. So why have I wasted, I haven't, this is a spoiler alert, why have I wasted a chapter of my book or half an hour here talking about it? Because the takeaways are incredibly valuable. What are the takeaways? This idea that it is a useful heuristic, and this is not just for discretionary traders. You can even, this finds expression in some, you can code this stuff in some ways too, but this idea of thinking about these forces of buyers and sellers and even personifying them into a guy that's trying to push the market around, that while it can be misleading, is, I think, whatever it cost you in terms of being misled, it will repay you many times over in a cued-in awareness and maybe a sense of a theory of mind of market movements. The idea that markets are always manipulated. And if you can't handle that, you can't trade. That's just it. If you aren't okay participating in a manipulated market, you cannot participate in the market. So this is also, look, it happens to everybody. You know, there are still times that I get ticked out on a stop, that I nail the exact low or high of the day in the bad way, not the good way, you know, on the wrong side of that with a stop or with an entry. And even after doing tens of thousands of trades, there's a temptation to say, oh, they got me, you know, is manipulated. Well, of course it is. And if you put yourself in that framework where you know the market is manipulated, then you don't allow yourself to cry over that, because it's just the way the game is played. Now, while I think this strict, I'm going to go back a slide, this strict idea of looking for the market to go sideways and go up and then go back down and then go sideways, while that might not be realistic, the idea that the market alternates in periods of trending where you're moving from one price level to another and then sitting at one price level, that is very valuable. And that is one of the very handful of foundational aspects of price behavior. Markets do trend from price to price. There's academic work that say that markets don't trend, but I've read it and I understand it, but I don't understand the mind that can create that, because it's like it's the same convoluted thinking that would say sunshine isn't real, or you know, consciousness is an illusion. One of the ideas that's going around now. It's so detached from experience, it doesn't make any sense. And then this idea that we can understand what manipulation looks like on a chart, which brings us to accumulation distribution. So the basic concept, somebody asked a question here, how do we tell the difference between accumulation distribution? The idea is that support will hold in accumulation, resistance will hold in distribution. Now this makes sense, because if you think about the pattern, here's your accumulation, then you have your markup, and then you have your distribution, and then you have your markdown. Now it's pretty obvious that in this first case that the buyer is putting something under the price, right? And over here in the distribution, the buyer's not willing to buy higher. In fact, the buyer's probably switched to a seller, we would think. So there's something holding prices down. And the mistake that people make is, well, okay, so here's a quiz. Let's imagine you're going to see lots of support and resistance in a moment on charts, but let's imagine that you're looking at a support level on a chart. Is that a better support level if it holds cleanly? So imagine you had a few tests that were precise to the pip, to the tick, to the cent. Or imagine that it was a ragged level where prices had been through that level and then traded back. Which one of those is better? Most people who come from a chart pattern mindset would say the first, because it's a nice, pretty chart pattern. But actually, what we should expect in the market is for these not to hold with perfect clarity, for these to be ragged, sloppy tests. And if you think about it, the action, and I laid this out, and again, I said I wouldn't read the book, but if you go back and read chapter 2 of the book, where I put you in the mindset of the operator who's trying to buy lower, there's not a precise price, right? That operator is trying to judge the market. So you might buy a little bit, you might buy a little bit, and then you might say, let's stop buying and see what happens. And the thing might fall under its own weight. And you're waiting to see what happens. You're waiting to see if other buyers will come in and then it will go back up. That tells you something about the market. But if that doesn't happen, well, you're a natural buyer, so you're gonna be happy to buy lower. So these levels, if the market is functioning like this, they will naturally tend to be ragged. And this leads to failure tests. Wyckoff called these springs and upthrusts. And you need to be careful with this terminology because I've always found it misleading. A spring is where you have potentially misleading, even though I know the literature very well. The spring is pretty obvious. The market goes through a support level and then comes back up. So you have this kind of like boing, like spring off the bottom. However, the upthrust to me sounds like something bullish, right? It sounds like the market is going to try to go up. It's exactly the opposite. What happened was the market made an upthrust through a level and then failed. So the upthrust is bearish. It's a failure to clear a resistance level. And just be aware that that's something I've seen people who have read Wyckoff and thought about this. And sometimes if they're really confused, this might be one of the things you're confused about because it's very easy to turn the upthrust upside down. I would also encourage you, while we're thinking about patterns here, to consider these in the context of what I am now calling reversal complexes. And a little bit of recent history here as I've been doing some more by hand pattern analysis. One of the patterns that I found myself drawn to, this is one of the ways that my thinking has evolved since the book, is I'm focusing quite a bit more on tails, on areas where the market has tried to go lower and reversed, as you can see quite clearly here in some of these. So I started doing a lot of by hand analysis, and I realized very quickly this is where a little bit of intuitive pattern recognition is extremely effective, that it wasn't just a matter of a single tail. And it's obvious if you think about it for half a second, but my intent was to look for these single bar patterns. And I realized that 2, and in some cases even 3 bar patterns were just as valid. So we expanded the definition to what we're calling reversal complexes. And this is the offset thing last week was a little controversial, but I got some interesting feedback on that after the fact too with people. It's very interesting when you share kind of a new idea like that. The feedback tends to be very polarized. A lot of people say this completely changed the way, yes, it's completely obvious, and it should be. It is an obvious thing. For those of you who missed the presentation, the idea was what you see here, these are, doesn't matter. I think they're 5-minute bars, maybe they're 3-minute bars, but they're offset. So the start of the bar is in some cases a few seconds to a few minutes. So it's just like we slid the bars over the data, and you still have the same underlying market data, but you have different patterns because the bars line up in different ways. Because the start of the bar lines up at a different spot. So you get patterns that look different on the chart, but they are not, in fact, different because it's the same market action that created them. So this points us to a way of reading charts that is very much in line with Wyckoff, because what we're looking to do is to understand the action of buyers and sellers that made these chart patterns, and it's very much anti-Edwards and McGee. Another sidebar there, I promise I will do my best to not rip too much on Edwards and McGee, but I do want to point out that this book that is considered the Bible of technical analysis by all of these certification programs was written by two people who were not traders and who tried to trade a few times and were not able to trade successfully. So now, for some reason, we have armies of people lugging this big book around and saying that this is the definitive approach to technical analysis, when it was a book that was written by failed traders. And that's a little bit hard for me to wrap my head around. And people who come from that school would tell you that each of these situations is quite different. Maybe they would say A and B are similar, but you can find little nuance of pattern here that shows you these situations are different. But if we understand that what we're really doing is taking a view, a perspective on the underlying flow of the market, it's going to, by necessity, be imprecise. And understanding that gets you closer to the reality of what's going on in the market. Here's the example from the book. This is an example of accumulation, and this is very typical action. This move here at A actually led to multi-month, almost straight up rally. And this is exactly the kind of thing that you see. Usually the tops in accumulation are not perfectly defined, and so you can't see an exact breakout and say, oh, time to go. But what you do see is, particularly following a big spike down, markets will tend to stabilize there. That's usually a short-term measure of accumulation. And if you get an upside break, sometimes you can get a really, really nice move out of that. So that's what accumulation looks like on a chart. If you want to know what distribution looks like, you just flip the chart around that axis. So, instead of these, and flip the colors of the bars too, I guess, but instead of these things happening at the bottom, they're now happening with attempted breakouts from the top that failed. And that is the place we're going to take our first break. Let's take a 5-minute break, and we'll come back and we'll dig into support and resistance. I'll see you back here in 5 minutes. Okay, welcome back. Here we go. So let's jump in with support and resistance. There was a question about the best Wyckoff book, and I think the best Wyckoff book is not by Wyckoff, but about it's a book about Wyckoff. Tom dropped it in the chat. It's called Charting the Stock Market, and the author is Hudson, Hutson. That's a very accessible. It's a relatively small paperback, pretty good read, and it lays out all of the essentials. Beyond that, there are a lot of people who, because the Wyckoff material is public domain, have done various things with it. So a lot of people who have built things around it or use it as the core of another approach, which is fine. I mean, frankly, it's what I'm advocating and doing here, but it's not. If you look at a lot of these ideas, you don't really know how much Wyckoff. So I think if you want how much Wyckoff you're getting, I think if you want to go beyond the Hudson book, I would just go back to the original source material. And again, it's a difficult read. Somebody pointed out a few people who do trade mainly Edwards and McGee's patterns. It's interesting. One of those people you mentioned, I think, has said would have been about 2010, 2011, that he didn't think the patterns themselves worked very well anymore, and that he thought that his success was because of his trade management and the other aspects of his approach rather than the patterns being valuable. And of course, I think there are a lot of people who are successful with approaches for different reasons, and that's one of the things that makes it difficult to untangle success. But let's turn our reasons for success. Let's turn our attention to support and resistance. So here is an intraday chart of the S&P, 3-minute chart. And the question is, where would you highlight significant support and resistance here at the end of the day? And I want to point out, if you are an intraday trader, one of the levels that you really must be aware of is the high of the day and the low of the day. We're going to talk a little bit more about that. And it's not. So the first lesson here for support and resistance is, we're going to come back to this a few times. What is support? Support is an area underneath prices. So it's a lower level where something might happen. So that's a different way to think about it, right? Because a lot of books will tell you that support is a place where price will stop going down. And the modern expression of this, YouTube is full of faux experts who I decide how much I want to say, but let's avoid the negativity. But just there's an army of people trying to hack expertise, and if you aren't familiar with that phrase, before you get too much into some of the gurus out there who kind of pop up out of nowhere, like with a lot of crypto expertise or whatever, Google that phrase, hacking expertise. There's a whole thing about that. And I have been on the side of that, where a lot of people have come to me looking, I saw what they were doing, looking to use me and my work as a way for them to hack expertise, to attach themselves to what we've already built. And just be aware that that's a lot of it. But the kind of modern expression of this that kind of drives me crazy is people talking about supply and demand trading as if it's some great new thing. Well, it wasn't really a great new thing when Wyckoff started talking about it, and it all goes back to Wyckoff. There's also some questions here about how to adapt this for individual stocks. How do you adapt the Wyckoff method? Well, that's what we're talking about. That's what we're doing. This approach that I'm advocating really is, in my mind, an approach that is rooted in the concepts and ideas that Wyckoff championed and created, but there's no Wyckoff method that I think is fully applicable to today's markets. But so if you want to use supply and demand, that's fine, but make sure in your thinking that you think these are areas where something might happen, where somebody might step in to buy the stock, where if the stock is going up or the currency is going up, where it might run into trouble. If you think, and I have a slide later where I encourage people to always say potential support and resistance. If you make that one change, don't look at a chart and don't put in your Facebook group or whatever, this market is coming down to support. Don't say that. Don't say that to yourself. What you need to say is the market's coming down to potential support. That word potential, it makes all the difference in the world in how it shapes your actions, your expectation, and your understanding of market action. You eventually might get to the point where if once this is fully ingrained in your thinking, you might then be able to say the market comes down to support, because what you'll understand is the support's an area where something might or might not have. You have all of that subtext packed into that word support, but until you're 100% there, and frankly, probably even if you are, I catch myself sometimes saying support and resistance when I really probably should be saying potential support and resistance. Make yourself do that. It feels a little funny, it feels a little awkward, but it's a change in your thinking that really can change the way you think about markets. So you've had time to look at this and think about it. Where would you draw support and resistance? This is one way to do it. This is probably not the best way to do it. This is this is drawing from every pivot forward, and this is in fact, so there's a seed of truth here. I've kind of carried this to a ridiculous extreme. We're going to go through this not really bar by bar, but window by window, and make sure we understand how these levels evolve. But just be careful. The point here is that if you have too many levels on your chart, the market's always doing something at a level, and you can always say a level worked. But the problem is, like I'm writing in red. Okay, so red was a strategic mistake for my lines here. But like, look down here. Look at the space between. If those were legitimate levels, there's obviously not enough room for a trade there. So you want to make sure that your structural understanding of the market ties in with how you're going to trade to make sense. So you basically have enough room for your trades in the risk reward framework. And that's a little bit down the road, but just something to think about. So this is not really how we do it. But I want to point out, before we look at how I do it, how I think you might think about support and resistance, I want to point out how this can go wrong and how we can think about these levels. So I said earlier, your brain is tremendous at matching patterns. And there's a lot to be said about this in the aspect of training your brain to see patterns. There is significant evidence that if we spend a long time working in a domain, and where a lot of this work has been done is in chess players and musicians, we find that the brain rewires itself so that when a very experienced chess player looks at a board, the part of their brain that's lighting up and being used is part of their brain that you and I would probably use for language, that they have been able to rewire for pattern recognition. It's also very interesting to you, and many of you are aware of this, but to use the chess player analogy, if you take a chessboard and you set up many pieces on the board, you can let a grandmaster look at that board for just an instant, just a second or two, and then turn away and set up the pattern on the board. And they can do that with 100% fidelity. There's a caveat. If I do that, I'm not a good chess player. Or if an inexperienced chess player does that, you're going to get a handful of the pieces in the right place. The better chess player you are, the closer you'll get to being right. But a very experienced player can glance and then reproduce, provided that the pattern on the board could emerge in actual play. So if you have some kind of nonsense arrangement of pieces, what the chess master, it turns out, is actually doing is looking at the chessboard. I promise this is relevant to trading, looking at the chessboard and then chunking. So they'll understand. And in some cases, there's a really cool video online where somebody plays this game with Magnus. And not only is he able to set up the board, but he's able to tell you what game and what move that pattern appeared in. So people do build these huge databases of patterns in their head, but it's based on an understanding of how what the pattern means and how it evolves. Magnus and I doubt this is true, but I've been told this, would be no better at remembering random arrangements of chess pieces on the board. I wouldn't want to bet money on that. But in the market, we see certain kinds of patterns, and we also do this kind of chunking ourselves. And you do need to be aware, though, that this machinery misfires, and it's brutal when it happens, because your confidence in the reality of the pattern, even if it's not really there, the way I said it is, your brain will find patterns where patterns don't exist. I remember as a child, like looking for patterns of faces in stars, of course, in clouds, in wood grain. You see dog faces in wood grain. Every now and then the Virgin Mary appears on a bagel or something like that. And what this is, by the way, one of the things that our brains are very, very good at is matching face patterns, because that would have probably been a very fundamental need for humans to be able to do that to survive. And so we're really, really good at that, but we'll certainly do it in the market. This also, by the way, this is not visual necessarily. Everybody knows about faces in clouds. We've been talking about this for years. My blogs on this that go back 10 years, but recently I've been realizing this isn't just visual. Conspiracy theories on some level, and yes, maybe some conspiracy theories are true, but I think what happens with a lot of conspiracy theories is that people see patterns and they see connections. Even if those connections between things aren't there, they look and they feel very real and they feel very convincing. And if you needed evidence that you don't have a good subjective measure of the reality of a pattern, I think the number of people who passionately believe some kind of crazy things, that's one measure. These are not crazy people. It's that sometimes maybe it is, but these are people whose cognitive machinery takes something that we do very well, and it's now working in kind of a perverse way. So what does this mean? Our tendency to pull patterns out of areas where no pattern exists. What do we do with that? Well, the first thing you need to know is that any line you put on a chart is going to seem to be important. Horizontal grid lines. This is why my charts do not have horizontal grid lines, because a grid line is an area. Once your brain sees that horizontal line, there is just, it's not much, but it's just a little nudge. It's a little nudge to say that line on the chart's important. And heaven forbid prices touch that grid line in the past, then coming up to it again, then my brain was just really good at putting patterns together. It's going to say, oh, watch that line. Maybe I want to watch that line, but I don't want to watch that line because it's a grid line on my chart. So that's something to think about. You also need to be aware that any line you draw, any trend line, any horizontal line will look like it's important, will seem to work. Any ratio, you can use any Fibonacci ratio, you can use any wacky ratio you want, and it will seem to be significant. If you use, I don't know, you use a ratio of 46% and look at that on your charts for a few weeks, and you're going to come back convinced that that 46 ratio is important, that it works, because you're anchoring to it and you're going to see the patterns about it. This is one reason why the close of bars, I think particularly intraday, can seem to be very significant, because it's a thing that we anchor to. Now, maybe some of these things I just said are real, but the lesson is you can't trust your perception. You always have to question, you always have to doubt, you always have to leave the door open, that even if it looks and feels utterly convincing, very real, very powerful, it could be wrong. You can easily see, if traders aren't aware of this, when we're operating in an environment of great uncertainty under stress, this is why we might make some mistakes. This is why we might get super attached to silly trades and do things like ignore stops and blow out accounts. Now, I also want to encourage you, though, don't go too far, because one of the common arguments against technical analysis is that you can produce various kinds of random walk charts, and you will find the same patterns on those charts that you see on real charts. Yeah, that's one of the classic games you play. Generate a random walk chart, put it in front of a technical analyst, and ask them where the trend lines are, where the consolidation is, and they'll probably, in most cases, be able to make that chart tell a story. So the cynical person looks at that and they say, oh, technical analysis is bullshit, because look, I gave the guy the random chart and he still found great patterns. So obviously it's not, none of it means anything. That's not necessarily true. And I don't want to spend the next hour talking about that, but let's just be aware that the ability to pull patterns out of random data does not mean those patterns aren't real, does not mean the pattern might not exist and might not exist with a predictive value in actual data. But it does call us to be humble. And I want to show you one of the things that this is also something that's been a little controversial. So in 2010, you can find this on YouTube. Here's a link to it. Go to my blog, adamhgrimes.com/random SR levels. That will take you to a blog that links to the YouTube video. And what I did was I took the chart of Baidu and I hid the price bars, changed the scaling, and then just dropped lines on it without looking. You're going to make the argument they're not random lines because humans can't do anything truly randomly. You are correct, but okay, it's not really a valid argument. And then I put the price bars back and I went through very carefully intraday, and these levels worked like magic. Now, why did I do this once? There's something called the file drawer problem, which is I could have done this a dozen times and only shown you the best one. This was literally the first time I did it. I did it, today I probably be doing it live, but I recorded it for YouTube and published it. It's the only time I did it, the only time I will do it, but you can do it yourself. So just follow that procedure, do it yourself, and see what you see. These are some of the screenshots from the video. These are completely randomly drawn lines. And the way I usually present this is kind of dirty. Like, I don't tell people these are random lines, and I go through and we talk about like all the clean, perfect tests. We talk about the things like the gap above and then the failure back below, the consolidation, the move away, and then the support here. We talk about the consolidation above the level, because obviously this is a super important level here, right? And and we read it like that. I only have two of these here, but you can see the same thing here. I point out that, like, when one of the levels is broken, as it was here, price usually moves to the next level and stops. And then once the level's broken, we have a little consolidation and then gap and go and run. So do it yourself. If you have never done this, if you see this, you're going to, well, actually, there's some of you know the Futures IO forum, used to be Big Mike Trading. When I did this, Big Mike started a thread there that became one of the threads that a lot of the moderators say is the best thread on the site, where people argue what Big Mike presented as the random line theory, which was my video. And the discussion there raged for several years and multiple pages, and people were kind of all over the place with this. But everything from anger to disbelief to deciding that they don't want to trade anymore because it's all meaningless. So this should bother you. The fact that any random line you put on the chart, and you won't know that. Again, please go do this exercise yourself. Watch that video, do the exercise, and think about the lessons. This does not mean that support and resistance aren't useful. I use them every day. They're foundational tools, they're core tools. But it's very good to think deeply about the tools we use and about ourselves. This really says a lot to me. It's not so much a math issue as it is a human perception issue. And if you know how you can be misled, then you're going to be a better thinker and a better trader. And the key question, I've just talked a lot about, I've led you down the row of nihilism. Levels are, random levels are pretty good. None of this means anything, yada, yada. Now, let me give you a much happier perspective. So the key question that we want to answer, one of the things I'm going to do here in these presentations, I told you in the first presentation that the first edition of the book that was not published was 900 and some pages. it was roughly twice the length of the book you have now. What we cut out was a boatload of quant testing and some of that I published in other forums, and some of it I've never shared. I'm going to share some of the stuff I've never shared in these sessions. But what I did was to subject the basic tools that I used to some pretty rigorous quantitative testing. And in almost all cases, the key question that you're asking from a statistical or quantitative test is you get your result. And what's your result? Maybe you're looking at the results of a trading system as a common one, or you're looking at how far price bounces off of a moving average or a level or whatever. And the question that you ask is, well, you want to know, did it work? But what does that mean? You got to be a little bit more precise. And the question you're really asking is this any better than what I could expect from random chance? Or, as I put down there a little bit more formally, how different is this result that I see here from my test? How different is this result from what I could expect if the test did not work? That's really what we're trying to ask. And there's a lot of different ways to do that, but I want to show you a kind of cool thing I did with levels. Some of you have seen this, but this is on my blog. In 2019, we asked about 1,500 traders to look at 20 panels. So what I'm proving to you here, I think, is that there is validity in some support and resistance levels. This should have immediate practical application for you and might change some of the levels you look at. So these 20 panels were kind of an A-B thing. I'll show you a sample here in a moment. And on one side was a real level, other side was a fake level. They're of course jumbled. You don't know which one is real. And your task was very simple: to choose the level that is real. And that's all we ask. We didn't ask like, how long have you been trading? What styles of trading do you do? Just use your brain. I'm not going to use a statistical test here. Instead, I'm hijacking the power of 1,500 traders' brains. Use your brain's pattern recognition. Here are some lines drawn on charts. Which ones look real? And I would assume in most cases what most traders are doing, if they're asked that question, you're looking for the line that price seemed to respect the most. So what we did, we looked at the S&P futures. We took 5-minute charts, and I took the levels that we looked at were the previous day's high and low, and the Globex session, the overnight session's high and low. We only showed the current day, so you can't see where the levels are anchored off of the other side of the chart. And for the real levels, that's exactly what we gave you, the 5-minute bars. And then if it was around the price, the previous day's high and low, and the Globex. Many charts, you don't see those levels because like some days maybe you just trend and there are no levels that are relevant. For the fake levels, we took the prices, kept the levels right where they were, and we shifted the prices by 20% of the daily ATR. There were no axes visible, so you didn't know what the prices actually were. We did the same thing with the euro. Somebody asked about the Bob Vollman books last week, and this research was done on, I think this was maybe a second book, the 2014 Understanding Price Action. One of his major claims is that round numbers in the EUR USD cash, not futures, are important. And this is how he designated round numbers: one spot 33, one spot 3250, one spot 32. So it's the 33 and 32, and then the one in the middle he called round numbers. And he presented over 400 charts, many of which focused on this round number. So we took from the time period of this book, which at the time was one of the main price action books that people were talking about. And one of the claims here is that these round numbers were super important. So we plotted the charts again, hit all the axes. Again, we're using the exact time that the book was written, just in case markets change somehow. And we either gave you the real market, or we took the price bars and shifted them half a round number, which should have obliterated levels. Now, this is tricky because all of this is random. Here's the sample. Here's one of the panels. Take a moment, look at this. Ask yourself which one of these is the real levels. which one of these panels is real. This is the S&P, and the real levels are in panel B. This was one of our test levels. Now, I did all of this randomly and didn't want to have any kind of thumb on the scale where I could have picked out ones that looked good or looked worse. It just so happened in this case that I think any rational trader is going to choose A. The tests on A are so much cleaner. Most of these were not like this, but this was one that I thought was particularly deceptive, and we kept it in just because. Now, what we learned, because we didn't want to manipulate the test anyway, what we learned, okay, so a couple lessons here. So one lesson is if you have never done this kind of statistical testing, the first time you see statistical results, quantitative testing results, they can be very underwhelming, because what you're used to seeing, right, when somebody presents a trading idea, you see it in a book and it has a P&L line that looks like this, and the person says, this is the best trading system, this is how you should trade, right? This doesn't look quite that exciting, right? But it's actually a lot more exciting. So what this is here, this on the horizontal axis, this is the number of people who picked the correct chart, the correct panel. And then the rows are the different tests. They're not numbered, but this is like, 1, 2, 3, 4. So, and then the big thick line in the middle, I'm going to erase my lines, that's 50%. Look what happened here on the S&P. We had 8 out of 10. These were the two that misfired. People were well north of 50%, meaning that people picked the actual high and low of the day as having more validity than the fake levels with a high degree of consistency. And by the way, the crappy panel we just looked at was here. Still, somehow 20% of the traders picked the other thing. Here, however, is the same test for the euro. And this is a radical difference. This is, to me, pretty strong condemnation of the idea that round numbers are significant in the euro at all. And it's pretty strong confirmation, which is good because I still use these every day. This is pretty strong confirmation that the previous high and low and the Globex high and low are important levels in the S&P. Here's another presentation of this is just this time ranked max to min, the number of trials that people got right, and you can see here's the 50% break for the S&P. Here's the 50% break for the euro. So that is one way to do it. And to my knowledge, I don't think this has really been done or published before. Rather than structuring a quantitative test, which is a little bit difficult to do, we've just hijacked traders' brains. And this does, these are conclusions that I feel pretty comfortable with. No evidence round numbers matter in the euro. Strong confirmation these levels are significant in the S&P. Of course, we might have missed something, but I would point out that this does also overlap with common sense. We've done, and I published similar work on Fibonacci ratios, moving averages. Not all of this is published, but a lot of the things like the Murray math numbers or the floor trader pivots, Camarilla pivots, all these things that people talk about, different level I've had for a period of time. Traders would send me calculations for levels that they were using, and in almost all cases, none of these are any better than what you would get from randomness. And this makes people very angry sometimes, particularly the Fibonacci crowd. Not big fans of my of quantitative tests of their work. But one thing that I think you will find, a lot of people who lean on these kinds of levels, how do I say this kindly? They're not people with rigorous quantitative backgrounds. You don't see somebody branding themselves a Fibonacci trader who has a deep background in some math heavy discipline. That's just not the way it works, at least in my experience. Maybe someone out there, but this idea of taking, and we're going to come back to this, and I'm going to show you things that absolutely do work and that do have an edge. But what you're asking in all cases here is this better than what I would expect out of randomness? The guiding principle is, and of course, when you start doing this work, you really subject yourself to whataboutisms. Somebody will say, well, wait. Did you test only the third Fibonacci level with a 14-period RSI and a 7 and 9-period stochastic in a Renko? No, of course I didn't. So, there's always some other way you can turn this and look at this. But and maybe I'm wrong, but this is, if you're listening to me and talk about these things and you're wondering, like, where's this guy coming from? My guiding principle has been that something cannot be both profoundly important and invisible in the data. It does not mean that it can't be hard to see, it can't be hidden, it can't be obscured. That's possible. But if you're telling me something is so incredibly critical that the Fibonacci ratios, for instance, are, somebody told me, an engineer who has written a bunch of trading books, told me that I was an idiot. That was the actual word that was used for ignoring Fibonacci, because the height of the Giza pyramid measured in inches was a Fibonacci number. I don't know what to do with that piece of information. And those of you who have had some math classes also don't know what to do with that piece of information. So, we can get as esoteric as we want, but if something is really fundamental to moving prices, it's got to show up in the data. And if we can't tease it out of the data, then I start to get very suspicious that it's bullshit. And if you can then trade without it, I start to become comfortable with it being bullshit. And that's the case with a lot of these things. So what do you do with this? Well, I think this is a call for humility and pattern recognition. I realize what I just said might not have sounded very, very humble, but what we're looking for is you go into any test or any assumption with any trading idea, whether it's a new system or a new pattern or a new approach or a new indicator, whatever, and your idea is that this thing probably isn't going to work. And what I'm looking for is, that's your what do I say? Your initial orientation. That's your bias, is that this thing's probably not going to work. Let's let it prove otherwise. And some things do prove otherwise, and those are the things that will keep proving otherwise for decades and decades. And I have some questions here. How do traders make some of this stuff work? So there are a couple answers to that. The most honest answer is I don't know. So that's probably the wrapper this should go in. But I would extend that with a couple other thoughts. So I don't truly know. Here's what I do know. I know that a lot of people are successful and they don't understand the reasons they are successful. Larry Williams tells a story about, and I've related this story before, but there was a group of old farmers who were very successful trading pork bellies, and they made so much money. The floor traders knew of this group of farmers who, by the way, let's be honest, might understand something about supply and demand in this market, right? But so Larry went to see what they were doing, and they sat down around their table. They had this regular investment meeting, and they pulled out a chart. And one of the guys had a pendulum. So he had some weight attached to a string, and he held it over the chart. And if it went in a circle in this direction, they bought it. And if they went in a circle in this direction, they went short. And they said, this is our whole system. And these were very, to use a easy phrase, I never want to write this, they're salt of the earth people. It's just such an easy, the people who were not lying, who were showing that they were proud of their success. They knew Larry to be a very successful trader, and I think at that time he might have even been a senator, and they were very proud of what they were doing, and they wanted to share. And Larry scratched his head and said, like, how can this be? But he was like, is that it? Is that all there is to it? It's like, yep, that's it. You don't draw any lines. You don't You don't think about what's going on out in your bar. Nope, nope, nope. And like, okay. And then they're, oh, wait, there's just one more thing. One more thing. So we do what it tells us to do. We buy it or we go short. But then if it's not a winner right away, we just get out of it. If it doesn't work out in a couple of days, we just get out of it. So obviously, these were traders who were successful, and they genuinely believed that their pendulum was the reason they were successful. But they also might have, I don't know what kind of farmers they were. Maybe they knew nothing about the pork belly market. Maybe they were pig farmers. They might have had some knowledge of fundamentals, and they also had a pretty rigorous trade management approach, and they had some common sense. If it didn't get out, if it didn't work, they got out, and they held the, oh, and they also said they tried to hold on to the ones that worked as long as they could. And that was an approach in that area, in that time of the market, when you could have been very successful. So I do think that some people are successful and they don't understand why they're successful. And the other thing that I know beyond a shadow of a doubt is that people lie. Do what you will with that. And let's get back to practice. So don't be misled by this. I have been, here's a personal confession. I'm the guy that is always like up on the rooftop, like shouting, but it might be random, it might be bullshit, it probably doesn't work, because that really is my orientation as a trader, and I want to be happily surprised, and sometimes I'm happily surprised. I'm always the guy saying, but remember, markets have a big degree of randomness. A lot of what you see is completely unpredictable, unreadable. You can't do anything with it. So what I have discovered is that that mindset has been, some people have internalized that in a way that is not constructive. Some traders have, and some traders that I've worked with have come to me and said, I think I realized that I'd assumed that it's not possible to trade successfully because you keep telling me that all of this stuff is random. And that's not my message. And, perhaps I so strongly speak on the side of these misfirings of pattern recognition and the imprecisions of a lot of these schools of technical analysis that it also needs to be offset with a reminder that what we're looking for here is a way that we can operate in the market that respects the reality of the challenges of the market. So let's get back to support and resistance. I left you with this, and I said it was too many lines. And these are some other charts that I believe are serious. This is the kind of thing that if you don't apply this kind of rigorous approach, you start to draw a lot of lines and look at a lot of potential intersections in the future and say things can happen. You've probably seen charts like this online. And these people think like this. Here's what I think is a better way to think. So let's go through this chart and let's think what would be happening. I'm going to add a few bars each time and kind of give you some commentary here. So this is one day in the S&P. Now, we do come into this with some Globex highs and lows. And frankly, I don't have them on this chart. I don't know where they are. I assume this is the Globex high, and I'll just tell you, it does not turn out to be important. We might want to be aware of some of these other Globex pivots. And when I say Globex, that's I say that because I'm like 100 years old, but that's the electronic system in Chicago. It's what old people will say when they mean overnight sessions. So it's the overnight high and low. The market opened, and let's focus our attention here on the day session. This is the opening print here, and we traded just a little bit higher than the open, saw pretty good rejection from the open. Next bar later, 2 bars later, pretty good rejection from the low. So it's pretty clear 2 bars into the day that we have a little bit of a range that's had some rejection. What happens? We slip through it. So now we go, look what's happened. This high remains pretty important. We know like everybody in the world can see that. Everybody in the world can also see this. And this is one of the things, the levels that will work the best are the levels that are very obvious to the most market participants because you're thinking people are going to take action around those levels. And the derived levels that work best lean heavily on those. So we slip through the lows here. And at this point, I really would not be watching that very carefully because this low is broken so easily. We won't carry it forward. So you can see what I've done here. I just kind of stopped thinking about that low of the day when it's broken so easily. There was obviously some dissension around this level. We would have been aware of it for a while. Really, this probably should be carried forward here. But once we start to have a couple rejections here, now this level becomes important. I'm going to clear my drawn lines. You can see that this is the level here. This is, I would say this little double top is that I have marked near the bottom is mildly interesting. It's not super important, but something we keep an eye on. It's broken pretty easily. And now, so this is one of the things where I admittedly was not, I did this in real time, by the way, looking back at my notes. I admittedly was not terribly interested in that level at that point in time. But once we start to have some action around it, you're allowed to go back and to change your assessment to say that, okay, so I guess that is a level. And I do want to point out these levels that I stopped drawing, these are levels that I would really stop thinking about at this point. And so that's kind of what I'm trying to communicate there. But here, what are our critical levels now? The high of the day, the low of the day is very obvious down there. And then we're dealing with some garbage around the middle here. What happens? We trade up a little bit higher. We make a run for the high of the day. One of the things that you can think when you get close to a level, there's an almost magnetic effect. It's a real thing. It's a thing that you can measure and quantify, but we really didn't get close enough for that to kick in. Instead, we were rejected, turned down. Now, this is a level that everybody in the world can see that I'm very interested in. And of course, very, very focused here on maybe we'll get a run to the low of the day. What happens? Okay, so this is important. Thinking about support and resistance, a lot of the areas that we have marked here, I've marked as lines. And that's really a little bit deceptive because one of the things that I say all the time, support and resistance are zones. Not if you're going to draw them on a chart, the right tool is probably a marker or a crayon. It's not an architect's pen. It's not a mechanical pencil with a 0.2 lead. It's not a precise line. It's a zone. And when you have this kind of rejection here, in this rejection complex, this then becomes a very interesting zone. If we were marking things perfectly correctly, we probably would be aware that this is actually a zone 2 to think about. But this would be the level that I would be most clearly looking at. And the reason that I'm not really thinking about this as a level is because what I think is more important is kind of this point. I think the market will likely treat that as a target. Well, I'm wrong. We don't quite get there. And now this starts to look this gap here. Here's another way to define support and resistance. So I had a very clear point level. We made a pretty good effort getting there. We didn't quite get there. Now I'm going to acknowledge the zoneness of this, the reality of this. This is in the very, very short term. This is the kind of action that you might see in a Wyckoff distribution area. This is price rejection where the market, I haven't said that phrase yet tonight, but it actually is the core operating principle of support and resistance, that if a level works, it works through price rejection. The market gets up there and boom, does not want to be up there. Now, what you understand from offsets, from the offset chart from last week, you should be viewing this exactly like you would view some kind of candle that looks like this, right? With some kind of big tail on top, because it is exactly the same kind of action. It is rejection from that level on good momentum. What do we assume? We're going to target this area. So this is the way intraday you can look at support and resistance unfolding and thinking about them as targets. As we get down near this area, look what happens right here. It's really hard to see this tiny mouse on a 4K monitor. As we get down there, we have a little bit of rejection, not very impressive follow through. Back down here again, a little bit more rejection. But you can see at this point what we have is really a validation of this support level. Going on, well, golly gee, we do manage to re-engage this level. This is, okay, here's an entire mini class in support and resistance right here. So look what happened here. Somebody asks, is this a kind of double top, double bottom concept? We're going beyond that. This is what lies behind double tops and double bottoms, triple tops and double bottoms, various kinds of formations like that. This is the price action. This is the action and dynamics that makes those happen. Yes, you'll see those expressed on the chart sometimes, but here's the lesson. Look here and look here. So what you see is a very clear difference. This is price rejection. Market got up there, boom, didn't want to be there. What happens here? First, like, look, maybe there's some minor rejection here, but then we have price acceptance. The market's happy here. So it is perfectly reasonable at this point, once we work through this level, every person in the world can see the high of the day. It's not far overhead. One of the other levels, by the way, that's not marked on this chart, and it was a mistake for me to not mark it on the chart, was the open print. That's one of the other levels I use because I believe we engage the open print right there. That's one of the best magnets for the day. It's something people don't talk about or think about enough on futures and also on individual stocks, frankly. So what happens? Well, we're rejected from that, and it's not marked on my slide, but this is, so look from slide to slide. This is why you have to, how do I say this? Okay. Every tick is new information. Every tick makes us reevaluate, reassess. And one of the challenges with testing patterns is that, yes, on balance, this is ostensibly a bull flag, should be a pattern that has a bullish edge. And if we test a few thousand of them, we should find that it has a bullish edge. But some percentage of them are going to fail. A fairly large percentage are going to fail because whatever edges exist are very small. But the question is, can we see these failing through price action enough to make discretionary management decisions that might, even with failing patterns, keep us out of some of the worst losses? The answer is yes, but this is just a case where the picture completely changes in a single bar, and you have to respond to that. The message, if you're reading in terms of buyers and sellers, look, you got a message from this market. This is, look at these previous bars. They're mostly white, they're mostly up bars, moderate size. It's pretty wicky, right? By wicky, I mean like shadows on the top and the bottom of the candles. It's not a super high conviction environment. Ranges are generally kind of contracting from the morning. Look at, if we had an ATR on this chart, we would see that and you can just kind of eyeball it, right? The range of these bars is quite a bit smaller than it was earlier in the day. That's normal, by the way, in the afternoon, but just not a super high conviction environment. And then what happens there? Well, I think you can sum this up as, oh shit, right? Because this is a complete change in market tone. This is a very big red bar, black bar, whatever you want, a lot of selling pressure. And again, if you understand the lessons of offsets, what do you actually have here? You had price acceptance that turned into price rejection, and you read this exactly as you would a wick, or if you're a currency trader, you might talk about pin bars. This also has now bumped our effective support resistance level higher. Now that we've had this action, now that we've had all of this work working through this level, I would assess this level as being higher. Then we get one of these holy crap moments where, look what happens. We blast through the support, blast through the low of the day, and then right back up. That wasn't very nice, right? But this does happen. Blasted right through this level. Now the only real levels that I would pay attention to here are this previous resistance level, which effectively becomes a target for any longs, and this now big expansion below that prior low of the day. So these red marks, and of course, the high of the day that looms just overhead. Could you think about a short here? You know, depending on how you trade, maybe. I would not be thinking about a short because I would be aware of the high of the day here. And, you know, if you're thinking about a short, you're probably more right than I turn out to be at this point. But, you know, again, this seems to be some process of price rejection, but we remember getting burned, or price acceptance. Remember getting burned here. So, you know, we're suspicious and we're thinking at least we should engage the high of the day. That's your thinking here. When you have a little narrow series where you have candles that have the exact same high or low on a low time frame. This is usually indicative of some kind of like almost artificial selling pressure in the market. And one of the trades beyond that is to sell a breakout beyond that and to see what happens. Because sometimes when that seller loses, and again, you know, I'm thinking in Wyckoff terms, right? When that seller loses, sometimes the buyers can really have a field day. And I know the high of the day is right there, but if we get through that, then we have some Globex levels we can start thinking about. And what happens? Well, it's one of the QSAT trombone moments, right? Again, you were justified back here in thinking about an upside breakout trade. What happens though is very obviously, and you have to frame this out in your trading plan so you're not making it up at the time. If you make it up at the time, I don't think you're going to make it up very well because you're going to be making different decisions every time. But you know, how many bars do you expect when you break beyond a level, you're just going to like blast through it and go? It doesn't happen all the time. There's usually some bullshit around the level. So the question is, how much bullshit, how much pain will you endure? And you probably need a number, you know, on your trading time frame. Is it 3 bars? Is it 5 bars? Is it 0 bars? It could be, but you need to be consistent. But, you know, at least in my book, when we've had several multiple failed breakouts here, the long trade doesn't start to look so good. And then you can see we come down and we're kind of here in a little bit of no man's land as we've broken below all of this previous stuff. Once we have a little bit of a slight exhaustion move or exhaust, I would watch this as a potential support level, which you can see ends up being tested. And this slides us into the end of the day. So that's just, you know, one of the questions that people often ask is, okay, how do you draw support and resistance on the chart? My basic answer is that you look at very obvious levels that everybody will see. And then, however, to give a better answer with a little bit more nuance, the question is, how do those levels evolve as price engages them? Because you know the reality is that a supplier demand zone, see, I'll use that language for you. Supply demand zone might exist in the market, a support or resistance level, a what? Potential support or resistance level might exist in the market. But as price engages that level is going to change. And yeah, there's some kind of bigger implication there, right? It doesn't even have to be the engagement of that level. As price does other things, other places, and other levels set up, the intensity or importance of that level might change. I thought it'd be useful to go through a day, look at how this evolves, and think about it. So this is one way to do it, and this is a way that I talk about in the book. But I don't think that I was quite as clear in the book as I hope I was here. I hope this was interesting. I want to show you something I did not show in the book. So this is the idea. People call this internal support and resistance. And you are more likely, when people talk about internal lines, you're more likely to hear about internal trend lines. There are a lot of ways to draw those. An internal trend line, and we're not talking about trend lines tonight, except when we are. An internal trend line might be a line like that. And my objection to internal trend lines is that there's a lot of different ways to draw them. Like how right? You know, they're not exactly best fit regression lines. I guess they could be. You know, it's an extremely subjective thing. One of the other issues I have with internal trend lines, and we'll come back to support and resistance in a moment. If I'm using a trend line, I got to think about what I expect around that trend line. And typically, like, one of the ways I might use a trend line is if the line is broken and then regained. So it like breaks below the level and then back below in a trend line, sloping level, that I might take that to be pretty strong confirmation of buyers being there. That might be a good potential long entry. The issue with an internal trend line is prices bounced around it like $1,000 times. Like, what do you expect? You can't really do anything with it. That's, however, the beauty of the internal support and resistance level. Calibrate your expectations. If we go back, I'm going to go back a slide. So here, we were expecting rather precise tests of support and resistance. We were expecting when we engaged that resistance area on the way up that maybe we would fail there, but we would see something. And if it held, maybe we get some dramatic action. Look what happened here. If it holds, maybe we get some dramatic action. We're expecting something to happen there, and it's not necessarily that it is valid to the exact tick, but it's enough, it's close enough to being valid at the exact tick that when we start to get action beyond it and no follow through, we start to say, something's maybe wrong here. However, the internal trend line doesn't give you that information, but I'm still, at least in my mind, I'm a little fuzzy on the validity of an internal trend line, but the internal support and resistance is quite different. Now, where do you draw this? So your eye is immediately drawn to this as a nice anchor point, and you should be careful about hitting random keys. You're probably thinking that this is anchored between these 2 points. No, that's not right. This line is actually drawn here. It's drawn here at this previous high, and it is not redrawn here. It is also not redrawn here because there's no conviction beyond the line. So what this tells us, when we have an internal support and resistance level, we did not know it was an internal support and resistance level here. We probably didn't know it was here. We probably did here. We probably did here. We did here. And we knew it was here, but it wasn't really engaged in any valuable way. What this tells us, once we know that we have a functioning internal support and resistance level, that shows us that price has failed. So what we're able to do when we're beyond that level, we're able to look for further examples of failure. Now, you might not get that failure, but look, I'm going to show you, for those of you who are familiar with my pattern work, you know that this is a trade that I missed, and I'm low-key hate myself for missing it. This is an this is a snap pullback in that failure of the internal resistance level. So what this tells you here is that once you see poor follow through here, you start to have a downside bias. You look on your lower time frames for patterns that line up with price rejection happening from that level, then that sets up those trades. Same thing here. You didn't know here really, it was not an internal support level. Let me clear these lines. You did not know, I'm going to change colors. It's not easy to do in PowerPoint, but it's worth doing here. How's that? These are the kinds of things that one should figure out before a presentation. Yes, I am aware. Okay, so I think this will work. Okay, so this is just a simple support level here and here. Here, we penetrated beyond it and it held well. We don't expect nice even tests, but then we had no rejection. You might have been looking for a breakdown here. However, once this stuff is obvious here, then you start thinking in this area, okay, we're now beyond this internal support level. Are we going to see price acceptance beyond that level and a short trade? That's certainly one possibility, but we're certainly going to be on guard for signs that this support is active and for strong trades back somewhere into the middle of the range. You got to frame out exactly how you're going to trade this. But this is not something I talked about in the book. But this is a very, very powerful tool, and it does apply. I mentioned to you that I started looking at some different time frames, and this is a tool. I struggled for a little bit to apply some of my existing methodologies to this weird ass time frame, and this was something that was kind of moldering and some of my old notes that I hadn't needed for a while. But it's not just, you might say, okay, well, great, like we know this is one of the most historically crappy ranging environments in the S&P, so you just chose a very good example here to put on your screen. It is in fact a good example on the screen, but you can also go back and look at this, and you will see that this is a valid concept. And there's more than one way to draw these, right? You can draw these in different areas. I do want to point out they don't always work. Of course, they don't always work. One of the best ways to use these is to go down to a lower time frame or to take really clear overshoots and rejections. You also can redraw these, and in fact, you probably should. A useful level might be more drawn through, that's not a straight line, but you know what I'm trying to draw there. You also then could start to carry this forward. So this is how you think about this. Now, you need to be careful that you don't treat these, you treat these as areas of interest, areas of potential interest. You do not execute a trade. The way to, I guess probably the way to trade a trading system is to show the areas where you can just execute at support and resistance. They do exist, but far more often you see that this is very, very typical garbage. And look at the pain beyond some of these levels. Look, even when the levels worked, if you had shorted here, if you shorted there and you weren't stopped out there, your stop's not in the right place. Like, you should have been stopped out. And you probably thought, if you're reading price action in any reasonable way, that this might have been setting up for a long. So you have to be willing to reevaluate the market as new information comes in. But that's pretty much my rant on support and resistance tonight. I do want to point out that trends break support and resistance. So that's just what they do, but support and resistance are not useless in trends. I haven't drawn the lines here, but now you can probably do it naturally, right? You can probably see very, very easily where support might have been, and when there was price rejection, it then failed, and where the levels just weren't there. One of the things that we can look at in trends, some of these kind of backwards facing levels become important, but we're going to talk a lot more about trends next week, so I will leave that for next week. Support and resistance, practical advice. We'll take a break here in a moment. The best levels are obvious. It's a good idea to get your support and resistance levels from higher time frames. And yes, if you use another analytical system, whether it's market profile or different ways of thinking about liquidity, this obviously overlaps with some liquidity areas. It's an important part of what makes this happen. You want these levels to be obvious to everybody. You want people to take action around those levels. And you might point out, well, so these levels aren't so obvious, right? But I think if you think to the next step, they are, because it's not obvious like you're looking at a razor edge in the market, but you're looking at a zone. You're looking at a place where price hasn't really been, and now it's here. And how is the market acting there? And that's very, very important. It could be different in different markets. You want to understand how people use the market, how people trade, derivative markets. For instance, if you were, let's say, you were charting the price of an option, and you can do that, right? Particularly a liquid option, you could chart the actual price of the option. I wouldn't expect to find the same things there because it's not responding in the same way. And above all, just think that these are areas where something might happen, and it's up to your skill in reading the developing story of the market to understand what is happening, to monitor price actions that develops, to not be stubborn, to develop the skills to see what is real and what is deceptive in the market. And just until you're very, very comfortable that that's a core part of your thinking, and we're talking years and years of trading, make yourself say potential support and resistance. And that should be, you should have that annoying voice in your head that if another person says this market's coming up to resistance, that voice in yours should say, oh wait, no, it's coming up, you mean potential resistance. You got to think like that. You really have to think like that. Words are a mind trap. If and I promise you, if you are lax with this, particularly if you're a developing trader and you say, okay, yeah, okay, I know support doesn't always hold, but it's support. It's your thinking is not going to be as clear if you don't force yourself to use this. I think it's very, very important. We'll take a little break here, and we will come back and forge onward with the 4 trades. And we're back. Okay, Betsy and Tom, let's do, I want to try to get most of the questions, so help me see those. But first of all, before we get to questions, and if you have questions on anything we've covered tonight or are going to cover, drop them in chat and we'll do our best to answer them. So let's go on. For trades. So this is something that I think is original with me. I had never seen anybody else frame this out quite like this, but it's not really revolutionary. It's just a classification system to say that if you are trading directionally, there are really only four possible trades. You can trade trend continuation or termination. You can trade for support and resistance levels, if you will, to hold or to fail. Digging a little bit deeper into these, so trend continuation, classic example. I want to point out this is not necessarily what we call traditional trend following, which is usually you're entering on some kind of breakout and then you're using some kind of trailing stop. That's certainly, that is a trend continuation trade. It's not the only way to do this. One of the other ways is to look for little pauses, little consolidations in trends, or to look at a place where a market is compressing. And to put this in the current market, if you take the current S&P where it's compressing, and you might assume that a move either up or down could be the start of a bigger trend. So trading that breakout, which we could then think is to stand, ideally to stand at the beginning of a trend, that is a trend continuation trade. Whatever a market is doing, and this is quantifiable to a small degree, whatever a market is doing, it has a tendency to continue doing. And this is, so if a market is trending, there's a natural edge for that trend to continue. If a market is chopping around, there's a natural edge for that market to continue to chop around. Now, this is offset. Some of you who think about these problems deeply are already arguing with me, and you're probably correct because you're pointing out that, excuse me, there are points where like markets become very volatile and they don't continue to get more like crazy volatile, right? That there can be some kind of like climax or some kind of blow off. You are correct. So it's not quite as simple as the market's doing one thing. It's always going to continue because we began this presentation, and you know this already because we began this presentation talking about cycles and phases. So it's not just that the current condition continues in perpetuity, but that's where the tendency is. Every trade you make involves uncertainty. Here's another way to think about it. It's not on the slide. Every trade you make is a question. You're asking a question of the market. You're asking a question of an uncertain future. You're looking into this, great, like roiling, unclear. You have like some guess what you're going to grab out of that future, and that's the best you can do. You're from that formlessness. You are structuring this trade and you end up with an outcome. So if you understand this, see, this is why I think, and we're going to talk about market psychology later, but I think a lot of the problems that people would label market psychology can really be addressed by putting the right framework around market action. And if you understand this, if you understand that every trade is a question, every trade is a test of a hypothesis, then you will know that every trade has the great opportunity for failure. And that affects how you manage those trades, right? Trend termination trades. So be careful. These are not, it's a weird name, okay? I know it's a weird name. It's an awkward name. It sounds so much nicer to say trend reversal. Why don't I just do that? Because they're not trend reversal trades. If I tell you it's a trend reversal trade, what we're going to look for is a market going up and you're going to get short and it's going to go to zero and you feel like a genius. Or you see a market that's just collapsing and you buy it and it explodes, like the Reddit stocks did. That's not what we are looking for here. It's one outcome. It's probably the happiest outcome. But what's far more common is you have a trend market that's trending and that trend just stops. That's one of the possible outcomes. So you have a trending market that then turns into a range. You might sometimes have the reversal, but you get that range, then that range can turn into a reversal, or the range can turn into further continuation. So what you're really looking for in trend termination, that name is awkward but precise, and we're not going to change it because what you're really looking for is for the trend to just stop. Uh, where with all of these trades, you should be thinking about where you might be able to structure like risk points where you know the trade is wrong. One of the principles of price behavior is that a market will do whatever it can to screw the most traders. And that's not the same thing as saying, oh, they got my stop, or, they manipulated the market to get me. Whatever. That's not what we're saying, because this is actually how the market works, and it's real. Because the market's job is to find activity. It's to find out where, it's to facilitate trade. The market exists so people will trade. And everybody knows this. Other traders know this. The exchanges want this. The exchanges certainly want the activity because they're compensated for that. And this is one of the great truths that's embedded in the market profile work. And it's a good book that everybody should read is the Dalton book. What's it called? Markets and Profile, I think is the book. The idea of the market really just being an auction, and all of these things that we see in the market spring from that. Yes, there's truth to that. Even though I'm not a fan of market profiles as a discipline, I think that that structure is reflects the underlying reality of the market. So because of that, because the market is always looking for points where it can find new orders, this is why the market always goes to levels and tests and probes. The market itself is asking questions. The market's saying, okay, so we have this market that's trending, and then it stopped trending, and now we have a resistance level. The market's going to say, hey, are there orders there? What happens if we go explore beyond that level? And this is just one of the most basic ways the market moves. And yes, everything you know about volatility and liquidity, everything you know about patterns really springs from this. This is one of a few building blocks, price action. One of the other trades, support and resistance holding. Well, I think we've beaten this to death tonight, right? You have to have some reason to expect a real level to be there, a level, and ideally a level other people see. You have to see how price acts around that level. Okay, so look, here's a little nugget that is easily missed. So one of the things that I used to do a lot with traders that I trained was to say, take a take you need to do a few of these. You need to do, like, I don't know, 40 maybe. Take 40 examples at least where a market is coming into a support or resistance level. And you want to make sure that some of them hold, some of them break. And then what you're going to do is go down to a lower time frame and take that level and look what happens on that lower time frame chart as the market approaches that level. One of the other tricks that you can do is to put a very short-term moving average. And I don't care. You can do this with a weekly and go down to a daily. You can do this on a 5-minute and go down to a 1-minute chart, 30-second chart. But whatever your short-term time period is, put maybe a 3 to 5 period moving average on that chart, and that's going to show you a little bit more about it's kind of like stepping back. It's a weird thing, right? Because we're going down to that lower time frame for granularity, but we want to step back to get an idea of the big picture flow, and you can see both of that, but both of those facets of that lower time frame by looking at both the price action and a short-term moving average. And your eye can probably do that, but it's a nice crutch. It's a good way to do that. If you do that, what this is going to do is turn on all kinds of connections in your brain for understanding how price acts around these levels, for understanding. I said, like we had a question here, like, what does conviction mean? How do you know a level is going to hold? How do you know a level is holding? How do you know a level has failed? Well, the truth is you don't know. The answer to all of those things is you don't know for sure. You can never know for sure, but how do you calibrate the probabilities? This is most likely what's happening, and this study of lower time frame action is one of the best ways I know to train yourself to see that. These trade support and resistance holding can be taken when the level breaks. And you might be like, wait, didn't you say holding? Well, if you follow through on what I just said, you'll see why that's valid. It can be taken exactly at the level. It can be taken before the level is reached. So it can be taken as the level breaks and then reverses, or not. Lots of different possibilities there. We're not looking at specific trades. We're just thinking about big picture structure. And of course, if support and resistance is not holding, you're going to automatically study this when you do that lower time frame study, then support and resistance is breaking. So there are specific trades that occur when support resistance break. And of course, no surprise, the breakout trade is probably the most common trade that people would think about, but there are others, and there's certainly pullback trades and various consolidation trades we can set up around this. But just remember that these are tricky, because one of the fundamental things the market is trying to do is to take your money, and one of the ways it will do that is with these probes beyond levels that don't lead to much continuation. So how do you figure all this out? Well, you got to define your trading time frame. That's one of the critical questions that new traders need to be absolutely certain of. What time frame are you going to trade? Because if you don't do that, you're going to discover that, first of all, you're going to be misled by a lot of patterns at first, but even if you can narrow the patterns that you're looking at, it's like your brain's like always grasping at these shiny things, right? And you might say, okay, I'm going to trade the hourly chart, but then, oh, look at that. I'm going to trade flags on the hourly chart, fine. But then you're like, oh, look at that flag on the 5-minute chart. Look at that flag on the weekly chart. So it's very easy to get pushed outside of your time frame. And the reality is that this there's information in those other time frames, which is what I just encouraged you to go find by looking at these other time frames. But the value of those trades is not necessarily for you to trade them, but it is a piece of you understanding and reading the price action. So one of the other things that you need to do is to think about clarifying your expectations for any trade. And what I mean is that a very sloppy way to think about trading is if you take like the breakout trade, let's just say you're looking at a daily chart, you're looking at a breakout trade. Well, the example that you would put in a textbook would be the breakout trade that happens, and then the price never goes back to that level, right? Starts at 30, goes to 50, goes to 500, never looks back, right? But the reality is that most breakout trades might last a few bars. And so you definitely have to understand what usually happens. You don't really want to look at those edge cases too hard, because you certainly want to be aware of them. And in some in some sense, the meat of the matter actually is defined by the edge cases, but that's that's another thing. What you really want to understand is, what can I usually expect when I take this trade? And in many cases, this means not just clarifying your expectations, but also tamping them down to make them a little bit smaller. We haven't yet talked about stops and targets, but this is a very useful framework to think about and to put all of your trades, all of your potential setups in. So one of the other things that people look at this, and I've spent now 6 or 7 hours here at the beginning of these talks talking about just basic building blocks of technical analysis. And a lot of people might say, you're making this too complex. And I understand, because I agree, at its heart, trading is simple. Good trading is simple. Especially good discretionary trading is not about weighing thousands of factors and calculating a lot of Bayesian stats and then maybe making a trade in 12 different derivative products. It's not, good trading is you see a pattern with a directional bias, you know your risk point, you execute the trade, you manage the trade. And that's what we're driving toward. But I don't think that you can get there unless you understand the details. And that's really, it's what excites me about these Hudson sessions, is having the opportunity to, we're seeking that simplicity. We're all seeking the simplicity. The only way this is going to be functional is, the only way you're going to be a functional trader is that eventually you see the truth with clarity, that you have, to go back to that quote at the beginning, that, not that you've fought through the darkness or overcome the darkness, but that you, all these areas of confusion and conflict that you have illumined, that the darkness is no longer scary darkness, that it's now an area of knowledge, an area of comfort. And this is, when you get there, it is simple. But the pieces, the way to that simplicity, I think, is through a complete understanding, and that involves some complexity. So I want to be clear. I know that a lot of people have this idea that technical analysis can be taught, and you hear some very good traders say, oh, you can teach everything you need about technical analysis in an hour, but I don't think that's true. I don't think you can teach the nuance. I don't think you can, and my goal here is to take those of you who are walking this path at various points and having various struggles, and to nudge you in the constructive direction toward your eventual success. Quick review here. Wyckoff Cycle is useful, but I would consider it suspect if you are looking at, if you're looking for something you're just going to be able to use as a cookie cutter, and you will see the cookie cutter picture all over the place, and it just does not carry through in the real world. But that's not the point, in my mind, of Wyckoff. We had a bunch of questions about how to adapt Wyckoff to yada yada, and my answer would be don't. That's not what we're doing here. What I'm giving you, I think, is my understanding of taking the tools and the perspectives that Wyckoff gave us and using these to understand modern markets. Composite man, the idea, and I will say buyers and sellers, that's a very useful construct to understand what the buyers or sellers are doing. And yes, usually it comes down to understanding how the buyers and sellers are trying to screw each other and what patterns that might create in the market. So great framework, it works. And you got to understand support and resistance. You got to understand how it evolves dynamically, how it's a constantly changing, I guess I just repeated myself, but just to emphasize that the probabilities around these levels shift every time the market moves. The idea of testing trading ideas, we're going to do a lot more of this. Next week in the trend stuff, I'm going to share some stuff that I don't think I've ever shared before on trend indicators and why these are not very useful. And then I would encourage you, most of you, I hope, are trading or have been trading, rethink your trading operations to date in this 4 trades framework, and ask yourself questions like, are all of my trades in one category? Do I need to look at other ways to trade? Do I need to, there's also value in specializing. So if you want to do that, maybe you're a trader who really understands the nuances of trends when they're terminating. So maybe you're a trader who even can look at trends that are setting up specific kinds of patterns that show large reversals. So maybe you want to specialize there. Let's just know that, right? But thinking about this framework and understanding that you at least have to be comfortable reading the big scope of market action through this framework, I think is very, very important. Don't pay attention to this slide. The next session is actually going to be on a weekend, not another Wednesday night. So this date is not valid, but we'll get that out to you very soon. Here's where you can find more about me. I think kind of the good central hub is my Twitter. I will tweet everything at Adam H. Grimes. You also can check out my blog. It's a pretty good resource. And let's jump to some Q&A. We got some questions beforehand. Excuse me while I turn my head here to read. So Thomas asks, to kind of simplify the question, he's looking at the offset thing. He's wondering if brokers can use this to front run trades. So, or I think there's also just kind of questions about front running in general. So front running is technically illegal. but it happens. It absolutely happens. And in fact, there are entire segments of the finance industry that are based on that. But I don't think they do it by offsetting charts, because I don't think that an offset chart gives you any predictive value. If you think about that, frankly, a lot of brokers know their customers' orders, and if you're a big enough broker, you might know you might know the book well enough that you have enough information there that you don't need to offset charts. If there were, think about this. If in here, here's the crutch to think about that. So if a broker could front run your trades by offsetting price bars, then you could get in front of that by offsetting more, and then you see the slippery slope, right? I want to keep the questions on topic here. Somebody asked about prop firms. So I think that's prop firms really it's a mixed bag, because it very much depends on the specific firm and the arrangement. I would be a little bit careful about how do I say this? Okay, if you're paying them, then you're the customer. So that's a prop firm. There are prop firms that will hire you, and you might work for free for a while, and that's okay. But if it's some kind of arrangement, I know there are a lot of these arrangements out where you pay money, then the business is probably getting you to pay money. I'm not saying that that can't be a good outcome, but I will say in the vast majority of situations that I know of, it's not a good outcome for the customer. So just be aware of that. I would say that you're probably, if you're a skilled trader, you're probably I totally lost my train of thought because I'm reading questions and my brain cannot truly multitask. So I have no idea what I was saying, but it was just reading a question. I think I'd answered that anyway. In my book, when I go through different strategies, I don't place too much value on volume. Actually, to be clear, I don't place any value on volume. And your question is like all these other people who talk about volume. I mean, I don't know. Like I do think that there are probably some isolated examples where volume is useful. Okay, I'll give you one. Here's a valid volume signal, and if you can manage your trade, you can make a lot of money with this. This is something that I don't trade, but I probably should. If you have a stock that makes a large move, and you have to define that, let's say a huge move on extreme volume, there's an extreme edge for continuation of that move, full stop. You got to manage it. You got to manage your risk. It's not a complete trading system, but it's probably better than most trading systems you can buy. So there's a case where volume has utility. But for the vast majority of applications, or for looking at chart patterns, I find that volume adds nothing. And I think that a lot of people who talk about it, like I do something very annoying. I know it's annoying. People tell me it's annoying. If I didn't know it's annoying, I learned. But I question everything obsessively to the point where, I mean, it could sometimes be a bit of a problem, right? But I think that a lot of people who use volume, imagine that I was trading successfully and I had volume on my screen, and I had never asked the question, do I really need that volume? So I might just blindly assume that I need volume. I might tell you how I use volume. I've never thought about, do I need volume? Does volume add anything? And if I'm most of these traders who talk about volume, I've probably never actually done any math. So like, I haven't tested this. I certainly haven't tested it in a rigorous statistical way. When I did that with divergence, when I subject divergence to a rigorous test, I stopped using divergence. So I think we're back to the point where some people are successful and they might not understand why they are successful. This is one of the things that I get the most pushback about. And it's fine if you want to use volume on your chart. It's probably not going to hurt you. It's probably not, I mean, my argument would be it's probably not going to help you, but I think enough people spend enough time like, asking this question, having this argument about, is volume useful or not, that I guess if you really want to use volume, every other technical analysis book tells you that it's useful, and a lot of people have built careers around telling people volume is useful. So use volume, I guess it's probably not going to hurt you. But what I guess I would encourage you to do is look at the correlation of volume to range on a chart. That's revealing, and then see what happens to your trading if you take volume off of your chart. That's how I would address that. Monik says that in chapter 2, I write, bear market rallies tend to be sharp and vicious, whereas pullbacks in bull markets are usually much more orderly. There is a surprising degree of symmetry. Most elements of uptrends and downtrends are nearly mirror images of each other, reflected around the y-axis, but most traders find that a very different skill set is expected to trade each environment. There's a typo, right? Not the y-axis. Most traders also find a very different skill set required to trade each environment. He then says, this is something I've been struggling with recently. I find myself more nervous to take shorts compared to longs due to the presence of long wicks and higher volatility in most bear flags. I'd love to hear my thoughts about entries and trade management for short pullbacks versus long pullbacks, and how my approach has evolved. So one of the things that you need to be aware of as a stock trader is you should have a long bias as a stock trader. And I tell you that as a trader who loves to short. I am perfectly aware of all of the reasons that we might like to short. I am more naturally inclined as a short-term trader to want to short stocks. You should have a long bias. Why? Well, stocks have an upward drift of about 8% a year on average. And yes, never cross a stream because it's on average X feet deep. But this is a statistical drift that is difficult to overcome. What you will find if you create trading systems, you will find lots of valid short signals in equities that are statistically extremely valid, to say the least, and actually lose money. So in other words, what I mean is you look at your sample and it goes up 8% a year, which is, this is back to the question of what we could expect if it were random. And you have a great short signal where your stock only goes up 2% a year on average when you have the short signal. However, if you short that, you're still losing money. Do you see? So it is more difficult to short stocks. There's nothing wrong with having a long bias in stocks. The answer to your struggle is to perhaps trade smaller. You could consider using option verticals as a possibility that adds some complexity that might not necessarily be desirable. Pullbacks are structures amenable to trading outright options because volatility. IV usually contracts a little bit in pullbacks, but that's one possibility. Trade smaller, use larger risk points. There's different ways you can manage this. There's a lot of things you could do, but I think what I want to affirm here is that the core idea of being a little bit concerned about shorts in the stock market, you're not wrong. Yeah, but it's worth working around that and seeing how you want to manage it. Okay, let's look at some of the questions y'all have asked tonight. Just kind of go up the list here. Is it valid to use anchored VWAP as support and resistance? To be honest, it's not something I have tested. I have done a little bit of testing on VWAP, not an anchored VWAP, because that's obviously, it's very difficult to test something like that. So an anchored VWAP is where you have some event, whether it's a critical chart point or a news event, a news pivot, for lack of a better word, is a common thing, and you anchor to that, and you calculate a moving average, a volume-weighted moving average in this case. There's a degree of subjectivity that makes that very, very difficult to test. I don't know. Like I said, I am aware that any line on my chart looks important, so I'm a little bit suspicious, but the full answer there is I don't know, because I haven't done the test, and I don't even know how I would do the test because of the subjectivity. I mentioned in both sessions that very few traders expect any meaningful form of success. How realistic is it for me to be in this 5%? Well, good news. More successful than you, more likely than you might think. So first of all, you are listening to somebody talk on kind of nerdy trading subjects for at least 7 hours already, right? You're here with me. And that tells me that you're doing. Keep in mind, like most of these people who fail open an account, they don't educate themselves. And I get, what I'm saying here is not that, like, I'm awesome because you're listening to me, but that you're doing hard work, you are educating yourself, you're working on developing the skills. Most failed traders don't do that. Most failed traders don't do what it takes to become winning traders, because if they did that, that's just not the kind of thing that, like, losing traders do, right? They want to gamble, they want to buy out of the money options, they want to sell income options until they get kicked in the nuts, and then they'll stop doing that. And but if you approach this as one of the most difficult things that humans can do, and again, like I said, sometimes I'm so negative on the by emphasizing the difficulty, that people just get in this mindset of, like, holy shit, nobody can do it. That's not what I'm saying. But acknowledge that this is one of the most difficult things people can do. It's probably going to be harder than you think. I joked with Tom a few weeks ago. I said, like, this is I was being overly dramatic, but I said nobody learns to trade unless they go through that phase where, like, you're sitting on the floor of your shower, like hugging yourself, crying. Like, everybody goes through that kind of, like, super dramatic, like, oh, I can't do it, failure, and so there does need to be a certain amount of grit and stick to itiveness to even get through this. But most of the people, I wouldn't be too put off by the fact that so many people fail, because plus those people will give you money eventually. Let's also remember that. You'll be taking their money once you figure it out. But just have some humility. Don't plan for, like, super quick testosterone driven success where you just crush the market. That's not the way it's going to work. What you're going to do here is to develop a skill that will need some refining, will need some time. It's not a straight line, it's a journey. I wrote a blog post on the trader's journey. Actually, Betsy or Tom, see if you can find that, which I know is a little, but it ties it into the Joseph Campbell monomyth. And yeah, it's a little ridiculous, but it emphasizes that this really is a quest. And if you take this quest seriously, there's gold at the end of the quest. I'll tell you that. There's a lot of gold at the end of the quest. Going from a pattern of success to a pattern of failure and deep losses is stressful. If stress undermines trading, then what can one do about it? Yes, you are correct. So there are various tools for dealing with that stress and for discharging it. The first thing that you can do is don't trade when you're under that stress. So for instance, let's say you're an intraday trader and you hit your loss limit like 3 days in a row, and you just took a chunk out of your account and you're really angry at yourself. Don't trade tomorrow. Like, nothing good's going to happen from that. If you, or let's say you're in the middle of a trading day and market goes to your stop and you double up and you let it go more and you take, like, a giant rip on the trade, it's not going to get better that day. Just stop. So you got to realize when you're emotionally compromised and step aside. And then there are certainly other things you can do, and we're going to talk a lot more about those. But that's a very good question. First thing you want to do is just remove the opportunity for you to hurt yourself when you're under stress. It's not the market that's going to hurt you, right? Maybe the market hurt you. Maybe the market gapped past your stop and you took a big loss, whatever. Chances are you hurt yourself, not the market, but maybe the market hurt you. But what's going to hurt you next is you. So Tom, we should write that down. What you're doing is you're not giving yourself the chance to hurt yourself. Mentioned the term derived levels. I wonder what I meant by that. Yeah, it's like it's measured move or different kinds of calculated levels, things like that. Or we actually have there's a set of derived levels that I use because they did test out statistically, and so some of these do work, but they're basically calculated levels. Other question, a bit confused how we can tell conviction. We're working on that. I think I answered it a little bit. We'll answer it more. Market profile talks about price levels needing repair. Have I analyzed that concept? Not strictly, but I'm aware of that, and I would say it's probably not one of the concepts of market profile that I would say I would consider pivotal. I'm so sorry, but I wouldn't say it's completely invalid. Just reading. Nico, I think we answered that question. My understanding the 4 stages made it easily visible in the chart. If that's correct, what's the right approach in applying or not applying these concepts? Also, we're going to talk about that over the next few sessions too. Oh, okay. Does it go to wrap up on? Who asked that? That's a good question too. Market character. Market character is market structure, price action. Market character to me, I would say, is more of maybe like a very short-term view of price action. It's kind of honestly, it's kind of a sloppy and ill-defined term. I should be a little bit more careful with that. But it's more, oh, no, it's not. No, it's not. Market character is probably my read, my theory of mind read of the market. That's what it is. Now, it's not sloppily defined. It's probably somewhat impossible to teach, but it's based on it's not like I'm just pulling it out of thin air. It's based on these other things that we're looking at. But I think I know that your work is a little bit more quantitative. It might not be so useful for you, but it's my subjective read on the validity or the conviction of the composite man on both sides, if you wish. Where can we get the slides? Tom, that's a good question. I had intended to make those available. We did not for the last one, and we will for the last one, and we will from this one. That was an oversight, so I will make sure that those are available. I'll update the blog post for the first session, and I'll link them there, and then we'll get them out in a bunch of other places. I'll make sure that they accompany. Maybe we can put the link in the YouTube too or something. So thank you for asking that. And then Frank asked if what's going to happen to my piano now that I'm focusing on day trading. So I'm focusing more on composition than piano, just because I don't have 8 hours a day to focus on building and maintaining piano technique, and I don't really think there's much in that. But I'll share some more of many of you know, but I'm a classical composer, and I'll share some more of that work on my Twitter here over the coming weeks. Okay, folks, thank you. I certainly appreciate your time and focus. Next few sessions are going to get much more specific and detailed. These first 2 were conceptual, kind of high level. We're really going to get into some of the details of trends, and we're going to spin this out over the next 3 sessions, really building kind of a comprehensive look at how price develops and both trends, ranges, and then how those fit together. Thank you, and we'll get the replay out as soon as possible. Also, keep an eye out for the next session. We're going to be moving the schedule around a little bit.